Leonard Cross, a semi-retired utility regulatory analyst with a specialization in public utility economics and intricate rate calculation, possessed an innate skepticism toward any bill presented without rigorous, auditable documentation. He was a veteran of decades spent advising state and federal commissions, where his daily task was dissecting billion-dollar balance sheets to ensure fairness and prevent corporate profiteering at the consumer's expense. He viewed financial statements not as mere summaries, but as complex puzzles meticulously designed to conceal inefficiency, excessive margin, or, most insidiously, fraud. His home in the affluent, master-planned community of Stonegate Falls should have offered him tranquil peace and a well-deserved respite, but instead, it delivered only a bewildering, consistently exorbitant monthly water bill. Stonegate Falls, in its characteristic suburban sprawl, employed a common, but often ethically fraught, utility arrangement. It used a single, massive, bulk water meter, managed and billed by the city water department. The Stonegate Falls HOA then assumed responsibility for the internal distribution network, the pipes, the pumps, and the submeters, and billed residents individually based on their usage. Leonard's household water consumption was conservative, reflecting the lifestyle of a retired couple, yet his monthly bills consistently breached the $150 mark, frequently spiking near $200, figures he knew were appropriate for light manufacturing or large-scale irrigation, not a typical two-person household in a cool climate. When he escalated his concerns to the HOA office, the treasurer, a retired real estate broker named Kenneth Vance, simply dismissed him. Vance scoffed, blaming the disparity on unavoidable system leakage, high system maintenance fees, and the general cost of managing a private infrastructure. The final, definitive straw that shattered Leonard's tolerance came when his water bill hit an astronomical $240 in a month when he and his wife were traveling out of state for 10 days, leaving all faucets off and no landscaping irrigation running. This was mathematically impossible. Leonard realized this wasn't mere administrative incompetence or justifiable leakage. This was a deliberate, calculated form of theft disguised within the opacity of common utility management. He determined that the only suitable response was a full-scale forensic audit that would expose the true mechanics and beneficiaries of the Stonegate Falls billing system. Invoking his rights under the community's governing documents, Leonard demanded and obtained the HOA's detailed financial records, focusing specifically on the water utility accounts for the past 3 fiscal years. He assembled and cross-referenced 3 critical sets of proprietary data, which, when placed side by side, formed the core of his case. 1. The city water utility bills. These represented the HOA's actual absolute cost based on the readings from the single bulk meter. 2. The resident submeter billing reports. This data quantified the total cumulative amount billed and collected from all 400 individual residents. 3. The HOA general ledger and disbursement records. This detailed the breakdown of where the massive water revenue stream was categorized and ultimately dispersed. Leonard's analysis began with a simple, yet devastating, comparison that any regulator could understand. Total water cost paid to the city versus total water revenue collected from residents. The numbers did not just fail to match industry standards. They screamed of systematic, institutionalized malfeasance. Over the 3-year audit period, the Stonegate Falls HOA had paid the city's municipal utility a total of approximately $450,000 for the physical bulk water consumption. However, the total revenue collected from residents via their inflated submetered bills was a staggering $950,000. This meant the HOA had collected a massive, unauthorized $500,000 in surplus revenue, a profit margin exceeding 111% over the actual cost of the physical commodity itself. Kenneth Vance's official and repeated explanation for this massive gap was non-revenue water recovery, or accounting for unavoidable leakage, plus a nominal, unregulated administrative fee. Using his professional benchmark knowledge, Leonard calculated the maximum justifiable leakage allowance based on industry standard, typically 5% to 10% of total volume and cost. Leonard's analysis proved that Stonegate Falls was effectively billing residents for more than twice the actual delivered water, or put another way, they were charging a rate equivalent to 110% of the water delivered by the city of profit margin. That was entirely illegal for a non-regulated entity. Leonard's deeper dive into the HOA's general ledger provided the smoking gun. He revealed the destination of the $500,000 surplus. Rather than being returned to the general operating fund, allocated for future utility infrastructure improvements, or dispersed as a dividend to the membership, the funds were systematically categorized as extraordinary contingency allocation and transferred quarterly into a high-yield off-book investment account. Following the paper trail of the transfers, Leonard connected that investment account to a specific shell corporation he found registered under the name of Kenneth, Vance's brother-in-law, a clear textbook example of illegal self-dealing, fiduciary breach, and outright embezzlement, all effectively masked by the complexity of fraudulent utility rates. However, the core of the legal case was not merely the embezzlement, it was the mechanism of the theft itself. By purchasing water in bulk and then reselling it to residents at an inflated, profitable rate designed to generate a substantial surplus, the HOA under Kenneth Vance's direct instruction and management was illegally performing the function of an unregulated public utility in virtually every state. Only licensed entities approved by the Public Utilities Commission (PUC) can legally charge variable rates, profit from the resale of essential public resources, and collect revenue beyond the direct cost plus a minor, regulated administrative fee. The Stonegate Falls HOA was functioning as a utility provider, complete with monopoly control and profit motive, without any of the required state permits, oversight, or rate regulations, making their entire billing operation illegal ab initio. Leonard bypassed the HOA's increasingly panicking legal team entirely. He compiled his evidence into a pristine, professionally sealed forensic utility rate fraud reporter rigorous 60-page document, complete with rate of return calculations, industry benchmarks, copies of the fraudulent ledger entries, and clear citations to state utility law defining a regulated entity. He filed this report along with a formal complaint alleging illegal utility operation and rate-setting fraud, directly with the State Public Utilities Commission (PUC) and the State Attorney General's Consumer Protection Division. The PUC's response was not merely swift. It was a terrifying demonstration of state jurisdictional power. For the HOA, dealing with the PUC was exponentially worse than facing a local civil court. The PUC recognized the immediate and profound jurisdictional threat posed by an unregulated entity illegally charging profit-generating utility rates, a practice that, if unchecked, could destabilize rate structures statewide. Within days, the HOA received a devastating, non-negotiable emergency order to cease and desist all internal utility billing operations. The order, issued under the full authority of the state, mandated the following crippling actions, none of which were subject to HOA appeal. 1. Revocation of billing rights. The Stonegate Falls HOA was immediately and permanently stripped of the right to meter and bill residents for water. The city water utility was ordered to install specialized individual direct meters or simply take over direct municipal rate billing for the community's master meter, charging residents the exact regulated municipal rate with no HOA surcharge. 2. Full restitution mandate. The HOA was ordered to calculate and fully refund all residents for the entire amount of the fraudulent overcharges, the full $500,000 surplus plus interest, accrued during the audit period. This massive restitution was mandated as an immediate credit against future HOA dues or as direct cash refunds payable within 90 days. 3. Massive regulatory fines. The PUC levied massive regulatory fines against the HOA for operating an unregulated public utility and engaging in rate fraud, totaling several $100,000, payable directly to the state's general fund. The financial impact was total, instantaneous, and catastrophic. The combination of the mandatory $500,000 refunds, coupled with the state's massive regulatory fines, instantly depleted and bankrupted the HOA's entire operating reserves and capital improvement funds. The board was left with no choice but to initiate a colossal, non-optional emergency special assessment on every single resident to cover the hundreds of thousands of dollars owed back to themselves. The HOA, stripped of its ability to manage its most essential utility, now faced an existential financial and political collapse driven by the very community members who had been victims of the fraud. Kenneth Vance, the treasurer, was not only personally named in the PUC's scathing findings, but found himself facing an imminent and high-priority criminal investigation by the state attorney general for wire fraud, embezzlement, and conspiracy related to the undisclosed contingency accounts and the shell corporation. He resigned immediately, humiliated, isolated, and likely facing lengthy legal proceedings and jail time. Leonard Cross, the utility analyst, not only eliminated his own exorbitant water bill, but triggered a full, immediate refund for every resident for years of systemic overcharges, demonstrating that when corruption disguises itself as complexity, the ultimate reckoning comes from the cold, hard, and unassailable laws of utility regulation, which always prioritize the consumer over the profiteer.